So each banking crisis is different, and a lot of people I think fight the last war. So a lot of people when they hear banking crisis, they immediately think of 2008, whereas that was largely a credit event. Basically, banks made a lot of bad loans that were defaulting. In this context, it's not that bad loans are defaulting; it's that actually very safe securities were bought at high prices, low yields, and as we've entered a higher inflation, higher interest rate regime, many of them have unrealized losses, which for the most part for like a big bank is fine because if you hold to maturity, you're going to get your money back. But if their deposit base is skittish because say they have a high percentage of not insured large business accounts, they can pull funding quickly and make a bank sell those securities at a loss. And for Silicon Valley Bank's case, their losses, were exceeding their capital because they managed risk poorly. But across the broader space, generally, when they increased rates this quickly, it put a lot of pressure on the existing asset bases of pretty much all banks, but especially skewing towards the small and the medium-sized banks, because when you have a liquidity problem in the banking system, it's not like liquidity can really leave the whole banking system quickly, but it can leave in any individual bank quickly, and so it can skew towards the larger banks and leave some of those small and medium-sized ones dry. For most banks, solvency is less of a problem than the other two, and that's what makes it different in 2008. Liquidity and profitability kind of go hand in hand because if a bank wants to keep its deposits, it has to deposits have to have confidence in it, but then also if they want to avoid the long kind of drag of capital leaving them and going towards things like money markets, they have to increase their deposit rates, and that's where you enter the profitability problem. And so I would say for the long tail of small and medium banks, I would say it's both a liquidity problem and a profitability problem. Because those, one of the ways they can try to shore up their liquidity is by sacrificing some of their profitability. For larger banks, it's less of a liquidity issue because they have, very large and liquid securities books, diversified deposit base, and they now have access to the Fed's facility as well. So for them, it just becomes, I think, a potential question of profitability. If some of those maybe large regionals have to raise their deposit rates more, I think to the extent that it becomes a profitability problem will in large part depend on the Fed. If they really push forward with tightening, that can continue to suck money towards things like money markets and away from bank deposits, and then that therefore requires banks to raise their deposit rates at a quicker rate. Whereas if the Fed eases off, that gives banks more of a reprieve. I think that's a big concern, but I also think even if you're, basically even from a rational perspective, at this point, if you're a business, for example, if you're operating a bank account that's above the insurance limit, you generally do want to take precautious actions because you can't assume necessarily that FDIC is going to back every deposit, right? It's something that at this stage seems somewhat likely, but you can't base business decisions on that assumption. So you have to assume a somewhat adversarial mindset and say, okay, we want to either diversify accounts, use bigger accounts, sweep extra funds into money markets. You want to take defensive actions, and none of that is particularly good for the small and the medium-sized banks. And so I would obviously advise people against making panic decisions or emotional decisions, but you do want to take rational defensive decisions. And based on the current incentive structure they've set up, that inclined people towards larger banks and towards money markets. There's also, there are some fintech companies that can kind of manage your money for you. So it kind of puts it out into multiple other banks. So you can kind of have a large amount that is FDIC insured because it's spread out. There are solutions like that could benefit. But overall, it's not a great environment for small banks to operate in. And small banks, because they're less liquid on average. They have larger loan books and less securities books. They have less use out of that new Fed facility compared to, say, the very large regionals, for example. So I would continue to be somewhat concerned about small bank profitability. And even if deposits are insured, there's still disruption if you have, say, one bank account with a small bank and then they have liquidity problems. obviously that can impair your business, even if it's just on a temporary basis. And so there are a lot of incentives for businesses to gravitate towards what they view as the most stable banks. I think we have to separate the rate versus getting there. Because on average, if you have like an artificially low rate, it's really hard for banks to make a profit because lending decisions don't really make sense. There's a very narrow spread, whereas a more normalized rate environment is a better environment for banks. But if you go from super low rate to a high or normal rate in 1 year, that's obviously very problematic for banks because a lot of them locked in loans, securities at lower rates. And then when you have in basis point terms, the Fed's move is the biggest since like the 70s. And on a percentage terms, it's the biggest ever, going from zero rates as high as they did, as quickly as they did on a year-over-year basis. That's basically the biggest 1 year move that we have, and I think that's somewhat disruptive. So I would describe it as basically that there's a difference between the end state versus getting there. And if you try to get there too quickly, that's obviously very bad for banks. It also depends on what bank, right? Because going back to the prior discussion, it's not as bad for the big banks. I mean, they can face some disruptions. Obviously, some of their loan books are not in great shape, but it's really bad for the long tail of smaller banks because they're the ones that are under more deposit pressure, or that can face more random liquidity runs that hurt their ability to run themselves. I think this whole thing kind of brought down the average base case for what the banking sector is going to look like, but it changed the large and the large regionals. So basically the money center banks and the large regionals, they are less impacted overall than the long tail of small and medium-sized banks. Because if you look at those large ones, some of them do have significant unrealized loan books, but they're in a much less likely probability of having to realize those losses than those smaller ones. That was even before the Fed facility, but now with that new Fed facility, there's even more defense against them having to realize those losses. But any bank up to maybe not the top ones, but any bank is subject to deposit pools. And even if they have access to the Fed facility, that's still a higher rate than they get with deposits. So it still impair their profitability. So I think the overall space is less attractive, but it's already been rapidly repriced for that less attractive world. And so I'm not particularly pessimistic on, say, the top 10 banks, even though I am, quite concerned about, say, that the long tail of the smaller banks.